Hi, Sean, you're on mute.
Mute. Okay, I'll do that again. Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is Thursday, February the 8th, and we have oil markets trading again a little bit sideways, stuck in a high 70s, low 80s kind of bandwidth. Brent crude oil this morning trading at 79.58, up about 0.5%. WTI about $5 back. Has been generally the trend. There's no shortage of things to look at about the possibility that this market, at least from a supply shock point of view, the old classic geopolitical risk premium loiters on the sidelines, ready to bite your ankles, but yet still remaining on the sidelines. Let's kick off this morning with one of our regular commentators, Andy Critchlow, the head of news at EMEA for S&P Global Commodity Insights. Andy, where do you think this market is going to take direction from? The politics is loud, but is it serious for the energy markets?
It's a really good question, Sean. Because on the one side, on the face of things, you have all this political risk, which we all know about. We've got the attacks in the Red Sea. Certainly, in the period that I've been covering oil and gas, and specifically looking at the Middle East, and that's 20 odd years. The same, I'm almost as old as you are, Sean. It's the worst I've ever seen it. But we don't see this risk premium anywhere in the market. You've got dated Brent trading, below $80 a barrel at the moment. Back in 2000, back 2005, 2007, I remember Abdullah bin Hamad Al Attiyah when he was OPEC president, talking about $25 a barrel risk premium in the market. Whereas if that's the case today, then actually the real price that crude should be trading at is closer to 50. So we don't really see it. And I find that quite remarkable. So why is that? Well, demand, we had a good year last year. Demand on average, was a record, somewhere around 104 million barrels a day. All all the drag in the market that was caused by COVID and lockdowns, etc., that had come out. We had a restoration of air travel. Economy's getting going again, a lot of trade. So all good for demand, but it seems to have slowed down. So, a lot of uncertainty around China drives everything, drives that Asian demand story. That's now, again, we don't know where that's heading. A lot of uncertainty around monetary policy in the industrialized world. Will we get an easing of monetary policy? Will we get the central banks start to unlock things a little bit more again? So if I look at our forecast, it's interesting. By 2025, we actually have Brent trading around sort of the mid 70s. So it's a very subdued sort of outlook for the oil market at the moment, and it kind of belies this profound period of political risk that is affecting things. And it's not just the Red Sea; it's Ukraine. It's a war with Russia. We have more. Much tighter sanctions now, which are impacting the market, and that's making it harder for the Russians to ship their crude.
And even that doesn't seem to be doing, maybe it's supporting the market. Let's welcome Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Arne, all things considered, $80 Brent is pretty good price for oil producers, despite the sort of what appears to be an unaffected or a somewhat agnostic oil market. This price would keep producers happy. What's your thoughts on its direction of travel?
Yeah, it's true. 80 is of course a nice price, and thank you for inviting me to the program. 80 is a nice price, but I think if you go to the Saudis, people say that they might need 90 to get the ends meet. But of course, there's some money in the coffers. But 80 is also a price that it still makes it quite attractive for non-OPEC producers to add more oil to the market. And I think the boom in U.S. oil production last year is a proof of that. We did see, was it yesterday, that the U.S. Department of Energy coming out saying that they now see a peak in U.S. oil production. Quite interesting. They actually said exactly the same thing a year ago. And fast forward 1 year, we have 500,000 more oil from the US on the market. So I'm not so sure that 80 will not make more oil come to the market. But on the other hand side, I'm actually becoming more and more positive on the demand side. The global economy is actually improving as we speak. I think a lot of people tend to forget that we saw these very strong non-farm payroll from the US. We're seeing PMIs actually edging higher. Even in Germany, you're seeing things tend to stabilize.
Well,
even
the
inside.
DAX in Germany is still quite bionic at 16,000.
Yeah, you could say so, but and of course Germany has been struggling a lot. And
I mean, you keep hearing about the end of the industrial complex in Germany, and the DAX keeps going up, and it's basically made up of the industrial companies.
Yeah, but it's also global companies. Do remember that, and of course they are also going up because the interest rates are going to go down. So the sort of discount account flow will add to that. But do remember, a lot of the German companies are global companies. They will benefit from a better global economy. They are benefiting from
but ultimately the challenge to the German economy is they're now having to spend a lot more money on energy. They might have a global market, but their cost of operations has gone up.
And that's a really structural challenge here for Germany. If you look at industrial production in energy intensive industries, that is down 20% in 2 years. We have never seen anything like that. Maybe during the height of the pandemics, what that was for 1 month, and then we recovered. But this seems to be a permanent thing. So yes, Germany is struggling. China is of course struggling. That's also probably a mirror of what's going on in Germany. But do remember, what's not happening in China might be happening in India, Vietnam, and so on. The global economy is maybe actually better than people think, and interest rates are probably going down quite a bit this year, supporting sort of the growth outlook. But yes, this is of course not back to 3-4% global growth now.
Well, let's welcome Ahmed Mehdi back to the table, Managing Director, Renaissance Energy Advisors, and visiting fellow at the Oxford Institute for Energy Studies. Ahmed, is $80 a glass half full or glass half empty kind of narrative? I mean, we are vulnerable to sort of a bearish narrative in the world. China's weak. There's, like we started last year, the recession is coming. The recession is coming, and the sense that there's no geopolitical risk premium because there's far too much supply and so forth. That there's kind of a bearish narrative, but yet there's a lot of bullish indicators. Your thoughts on the direction of price at the moment?
So I would say that it's not necessarily a totally bearish situation. I would say, however, it's a different demand dynamic this year. So yes, I agree with what the previous speaker said in terms of perhaps a soft landing situation in the US. But I think, China is still, we're dealing with a different issue here in China, where actually a lot of the in terms of actual crude demand growth this year, where a lot of what's going on in China, gasoline demand, we're talking about potential peak this year. We're talking about still ongoing situation of the property sector, ongoing issue with the crude versus NGLs in terms of demand, so LPG versus naphtha versus actual crude. So there's a situation as to how much of that demand growth is actually going to be met this year by non-OPEC supply as well. So for me, $80 is still a fair price for where we are today.
Yeah, it does feel like that. Andy, I want to drill a little bit into the geopolitics and where that intersects with the energy narrative, particularly in the context of Europe. Obviously, that's where you are. We're seeing the increasing struggle of financing for Ukraine in the US. There's a lot of politics around it. It, of course, is an election year. but nonetheless, they're struggling to get the next tranche of money to Kyiv to keep the war effort underway. My question ultimately is, does Europe have to start planning for a post-Ukraine war energy policy?
Yes. Yes and yes.
And what does that look like then, ultimately?
Yeah, well, it's a great question, and I think that you've got to frame it in two parts. That politics and geopolitics is going to have a huge impact on energy markets this year, and one of the big reasons is 2 billion people are going to the polls. We very rarely, you had a scenario where so many people globally, so many democracies will have general elections this year, and you have them in Europe, you have the UK, of course, the United States, which is the big one, but you have elections all over the world, in Asia, and this is going to have a dramatic impact on energy policy, because there's two parts to it. So you have the hard politics part, which is what you're talking about, I think, and it's the what happens with the war in Ukraine. I said last year, actually at the end of last year, that my view, or middle of last year, was that the Ukrainian counteroffensive was going to fail, and we're slowly grinding to this situation where there will be some sort of negotiation and there will be some sort of peace deal. I think that narrative still holds true. But we've talked about this before. US sanctions very sticky historically. You look at the situation with Iran. If in a scenario there was some sort of rapprochement, some sort of deal, some sort of back down on either side, would you see sanctions lifted very quickly? I doubt it very much. Long term, I think that Europe has done a lot to change its energy system. Obviously, it's bringing in a lot of gas, LNG now from Asia and from the Middle East. But it's really important here, and you alluded to it in previous question. The US last year, record production, biggest producer in the world, biggest 21 plus million barrels of liquids produced, incredible. You compare
and LNG, biggest in the world.
And the biggest in the world, 10 million barrels liquids exported. That's the Europe's energy policy. That's what their kind of get out of jail ticket on this, because the US has very much replaced Russia and is in a position long term to replace Russia as Europe's primary energy supplier. But then the second part of that is the election situation, and I think what's really interesting now is that energy transition. This is the first set of elections, general elections, that we've had where energy transition is actually been politicized, and in a way, actually perversely, that will slow energy transition down potentially. And you had the UK is a great microcosm of this at the moment. What's happening? So you've got both political parties basically jostling now to row back on their net zero commitments, row back on their energy transition commitments. So you had the Conservative government; they were first to go and say, well, this idea of banning the sale of internal combustion engine vehicles that was going to kick in 2030. Well, we're going to kick that can down the road, and maybe we'll do it in 2035, because
it's all about the energy security narrative is kind of strangled.
It's strangled everything, and it's given them a platform to basically kick the energy transition argument down the road, because no one really wants to do it. And
now kind of the Trumpian kind of bark is out everywhere. I mean, whenever I get into Gaza, but it's everywhere. Arne, just wanted to give you your thoughts on the same question, though. A post-Ukraine war energy policy. I mean, maybe one of the reasons that German industrial companies are doing so well, because they are expecting that cheap Russian gas to come back.
No, I don't think they're expecting
your
that.
Thoughts? What does a post-Ukraine war European energy policy, how different would it be? How similar would it be to what was before?
First of all, one lesson learned is that we can never, ever in Europe be dependent on Russian gas again. So that will not go back.
It's a nice statement, but I'm sure Siemens likes cheap gas, just like you and me.
Yeah, sure. And yes, but maybe Russian gas will come back, but I think there'll be a lot of sort of political will that there needs to be an alternative. And there will be an alternative, because LNG will continue to build, and and LNG from the US will continue to flow to Europe. So that's the first thing. And there's a green transition, and I think I kind of agree with Andrew that there's a huge political will to boost that, but there's also a concern if you're moving ahead too fast. You might give a very strong political opportunity to very right-wing parties. We're seeing that in kind of way in Germany with Alternative for Deutschland. We're seeing it in the Netherlands. We're seeing tendencies for it in
I don't think
Italy.
AFD would have any problem buying oil and gas from Putin.
No, and of course the more mainstream parties know that. So they know if they push the green transition too far, people will kind of rebel. If they feel that inflation is going up, their monthly bills going up, it's going to be very expensive to fill the car. Then you're pushing voters in that direction. And so it's a tug of war between these two things. But for now, I think there's actually quite a strong will to continue down with the green transition in Europe. We saw it earlier this week with this 90% target for 2040. But of course, there will be a lot of struggling going forward. So will Russian gas come back? Russian oil come back? I think it will take quite a few years.
But ultimately, if you're planning, like at the end of the day, and I don't want to get too far down the rabbit hole, but at the end of the day, Germany has not built any onshore regasification units. It's got floating regasification units, buying LNG from America on the spot market. Yes, it's done recently some long-term deals with Qatar, but overall, a lot of the pieces of the puzzle that have been put in place in the last 2 years have a temporary framework look to them. Let's go to Ahmed. Yeah. Ahmed, I wanted to get your thoughts on all things Iraq. And I know it's a country, obviously, you watch very closely, know a lot about. The politics, last night we had the news that the Americans drone shot and killed a number of militia leaders there on the streets of Baghdad. How serious is this, do you think, from the point of view of the contagion concerns for the region?
So, I mean, the country has perhaps been in between tensions between US and Iran before. It's not the first time. It happened in 2019, where perhaps, it was a dynamic that was more escalatory at that point, and 2020, obviously. I think it's just important to say that there's no sort of one militia groups. It's a big fragmentation of different groups. Some are integrated into the state. Others are perhaps more transnational with links to groups who want an escalation. But I think overall, the market is obviously not pricing in a wider flare-up. It's an election year. Iran doesn't want an escalation. More importantly, there are different dynamics between these groups in terms of their position. I think obviously the risk of there being a miscalculation is obviously there, but at the end of the day, there's not actually been a disruption to supply as yet. Rather, there's just been a higher cost in reoptimizing flows, and obviously there's been an impact on freight and crude purchasing decision making. But in terms of your question about what it means for Iraq, I think that it's been there before, so to speak, and more importantly, there is a tit for tat situation, which is very much we've seen this playbook happen before. I think that there is a risk perhaps of groups like Kataib Hezbollah and
I mean, I know we've seen some of this playbook before, but I can't remember the last time we had the US dropping missiles on about 4 countries all at the same time. I mean, it does feel like
I mean in Iraq specifically, but my point is that in terms of the risk of this escalating, we have to bear in mind what the limiting factors are for the US and Iran. So that sort of status, that consensus of this being contained, I think is still
Still
holds.
holds. We've still got this in the box. Let's go to the survey question, which is looking at this European question we put forward. Is it time for Europe to start planning a post-Ukraine war energy policy? Yes or no? I'm not sure who I'd depend on more if I was a European energy policy maker, Trump or Putin. There's a rock and a hard place. I've ever heard one. Andy, where is supply in all of this? I mean, there's a lot of demand concerns, right? Macro, I don't know. Recession, I don't know. But from a supply point of view, we're dancing along with 6 million barrels of idle capacity. Ultimately, this market isn't going up because with this geopolitical risk, because there's a heavy wet pancake of 6 million barrels of idle capacity on top of it. Your thoughts on where supply goes, where OPEC Plus looking at all this, where their strategy needs to go?
I think supply is only going one way, and that's up. And I think a great barometer and justification for that is Exxon buying Pioneer in the US. They didn't buy it just to sit on their hands and spend all that money and just produce the same amount of oil. They bought it to squeeze every last barrel out of its resources. You look at the Permian, and by some estimates, only 20% of the Permian has been utilized. So there is a lot of oil there to be extracted. BP.
Are we starting to see maybe the oil markets managed like De Beers managed diamonds? There's lots of diamonds, but just keep them all locked in the closet and make them really valuable and expensive.
Yeah, I mean that mining analogy is actually a really good one for the way the industry is structured onshore in the US now, especially in the shale plays. And talking to someone actually yesterday about this, and that's exactly the way. Well, they actually described it as farming, and it's economics. It's the way it's structured is far closer to that. So it's about producing more. So I do question this idea that we might have seen a near-term peak in US production. I think it's going to go higher, and you just got to look at the company statements now coming out with earnings. Exxon, BP, the other day. You look at some of its projections for BPX. It's onshore shale division there. You look at offshore, what they're looking to do. They're looking to get to 1 million barrels in the US in short order. So everyone's looking to add barrels who has a position in the US. So I only see it going one way. So I see more oil. And then you look outside the US, you look at Brazil, you look at Guyana, you look at what's happening in some of the African countries. Angola did not leave OPEC because it wants to produce less oil. It's left OPEC because it wants to produce a hell of a lot more. And what does that say about OPEC? I think the really profound thing is compare that to Saudi Arabia now. With Aramco, with its very surprising decision to not go ahead with its plans to increase capacity. And I think that increasingly the question
$25 billion better spent elsewhere.
Well, I mean, they don't seem to agree with that in Abu Dhabi, do they? Because they're still plowing ahead with raising capacity at 5 million barrels a day. They want to have all this infrastructure in place, the storage caverns. It's not just about the upstream, it's about the downstream with them as well. So I find it fascinating, actually, how long those core three producers in OPEC Plus, the UAE, Saudi Arabia, and Russia, how long it serves their national interests to pursue the same policies within the OPEC Plus alliance. Because actually, you are starting to see signs that is fragmenting. And, I think Aramco's decision to kind of sit on its hands in terms of capacity increase is a good indication of that, because they're not doing that in the UAE. ADNOC is not.
Well, one of the things I thought was interesting about that announcement, I mean, obviously the surprise of it, but that they were very, very categoric about making it clear that it was a government decision and not an OPEC decision, or not an Aramco decision.
Where does one begin and the other one end?
Well, that's true. Publicly traded company. Aaron, meanwhile, while there may be lots of supply coming from many different places, and a glass half empty thought about the oil price if you want. But in middle distillates and diesel and so forth, there does appear to be a tightness coming in the market. We're seeing in Europe and elsewhere. Your thoughts of the outlook for middle distillate, for diesel and elsewhere, tightness may come and prices move higher?
I think the tightness has actually been there for quite a while. If you look at inventories, both in the US, ARA, we have quite low inventories, and you have a refinery sector in Europe that has been struggling with sort of changing from, heavy sour Russian oil into more light US oil. So the issues has been there. And if we're going into, and then we can of course add the going south of the Cape to that equation. So yes, I think the market is relatively tight, and it's actually, if we go back 1-2 months, it was very much in jet fuel, and seems to be moving more into diesel and gas oil now. So yes, it's a tight market, and I think it could actually continue for a while. But let's see what happens. But yes, there's a tight market.
What impact does the Red Sea closures? What impact is that closure? But the Red Sea shipping disruptions, what impact are they having on the flow of middle distillates?
If you look from a European perspective, Europe import a lot of distillates, especially jet fuel, but also to a certain degree diesel and gas oil from the Middle East, China, India, all going through the Red Sea. So that of course has to go south of Africa. So there we're talking about delays, not stop in production. Of course, so that's the impact.
And somewhat absurdly, because that's kind of the earlier comment, the earlier idea that meanwhile, right next door in Russia, there's ample supply of all of these products, and you're shipping them halfway around the planet. It just seems unsustainable.
They didn't have that many product last year. Actually, they had to stop exporting for 2 months during a harvest. So yes, and hopefully also these Ukrainian attacks on all infrastructures actually also having an impact. So yes, you are shipping Russian products around the globe. That's a part of the sanctions, that we will not stop the ability to export, but we will try to push some cost to them. So yes, basically what happened is, of course, that you ship crude oil to India, China, and then you ship it back to Europe as products.
Yeah. Ahmed, I wanted to get your final word on this news overnight in Iraq. Again, the news that Gazprom has been awarded the southern Nasiriyah oil field with a current production of 60,000 barrels a day. Your thoughts on that decision? What does it say for the future of that development and other? I mean, as we see the Western IOCs exit from Iraq.
Sorry. The question was, what do I think about that decision?
The decision to award that oil concession to Gazprom.
Yeah,
I'm just saying, generally, we're seeing non-IOCs taking up the development of these major fields in Iraq. The Chinese come in, and others, as Exxon and others leave.
Yeah, I mean, yes, there has been obviously Exxon's departure, which is still actually being transferred currently. Gazprom still has a very small presence. I mean, they have a position in Badra field, which is still quite a small, about 50-60 KBD. I would say Lukoil is probably playing a bigger role with West Qurna 2 as part of the incremental growth plan that they have at the field. But still, there was a recent adjustment done to the production targets, which is really a function of the constraints on the infrastructure side in terms of export capacity. But nevertheless, there have been some developments on the midstream and downstream side with refining. So it's just a part of a broader picture with lengthening the wider lengthening of the supply side on the gas oil balance in the Middle East, with Karbala now, and obviously with Al Zour and Duqm and other refining developments in the region. But yeah, to your question as to IOCs split. That's not a new thing. There's been a trend of IOC portfolio reconfiguration, particularly where non-core assets, as part of the wider story around post 2014 portfolio reshuffling, and obviously Iraq has been part of that. So Exxon, you saw Shell exit Majnoon many years ago. BP is still there, but there is really a development towards, I don't think Exxon's departure is going to impact much the production profile of West Kurnam-1.
I mean, one of the principal reasons that there was these fractures with the IOCs is the return on investment into Iraq was seen as just far too low. Has that changed? Is that going to continue to be the case for these other companies coming in, or are they getting better deals?
Well, there's been the development of new petroleum contracts, which is trying to move away and trying to be more competitive than the incumbent technical service contract. So you have basically an attempt to share more of the risk between the contractor and the government. And we've seen that with the fifth licensing round with players there. But overall, there is a issue. I mean, the way that you can sort of see how competitive the situation is actually from the OSPs, because that actually determines the tradability of the oil that they get paid for back in the cost recovery. It's very complicated, Sean, but basically it's still quite uncompetitive. And a lot of
but they still seem to be.
There's an attempt to improve the competitiveness, is the best way to put it.
Well, whatever it is, it still seems to be that Iraq can continue to add production capacity as the years go on. We'll have to leave it there. Is Europe time to post Ukraine energy policy? Yes, by a big number. We'll post that on social. Oil markets, as we said, trading Brent 79.63 a month ago. On the 8th of January, it was 76.12. So we've been up to 84 and down again, a tight enough band. Is there anything out there that will break it out of that band? We'll have to see. Meanwhile, thank you so much, Ahmed Mehdi. Nice to see you again. Hopefully we'll see you in London at IE Week. Andy Critchlow as well. Thank you so much. Hosting the show tomorrow. So you got to tune in for that. Arne Rasmussen, thank you so much for joining us again. Look forward to seeing everybody soon. 10:30 UAE time every day. All the best.
Thanks a lot.